Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Welcome back to the channel, where we dive deep into the fascinating world of hard-to-borrow stocks and the mechanics behind a potential short squeeze. Today, we're putting a specific company under the microscope, BIYA International Group Inc., trading under the ticker BIYA. We'll break down why the stock recently appeared on our screener and what the data tells us. So, who is BIYA International Group Inc., or BIYA? Short company logo /info. This is a technology and software application company operating in China. Through its subsidiaries, BIYA provides essential human resource services like job matching, recruitment, project outsourcing, and labor dispatching for businesses. It also handles HR management, payroll, and electronic contracts. Currently, BIYA has a market capitalization of $88.03 million and an estimated float of just 2.7 million shares. Looking at recent price action, BIYA is down 11.97% today, minus 6.93% over the last 5 days, and a significant minus 61.76% over the last 30 days. Today's volume sits at 1,804,196 shares, which is only about 0.3 times its 30-day average volume of 5,739,995 shares. What is cost to borrow and why it matters? Before we get into BIYA's specific situation, let's quickly explain cost to borrow, or CTB. Show CTB text. When you want to short a stock, you first have to borrow shares from someone who owns them. The cost to borrow is the annualized fee you pay to do just that. It's essentially the interest rate on your borrowed shares. Why does this matter? A high cost to borrow indicates that there's high demand to short a stock, and critically, a limited supply of shares available to lend out. When this fee skyrockets, it puts significant pressure on short sellers, increasing the cost of maintaining their positions daily. These fees can easily exceed 100%, and you'll imagine paying more than the stock's value just to hold a short position for a year. Why the stock is hard to borrow right now? This brings us directly to BIYA. Our screener flagged BIYA due to an extraordinarily high cost to borrow fee of 779.7% annualized. Highlight 779.7%. That is an incredible number, signifying that borrowing BIYA shares right now is extremely expensive. While the exact number of shares currently available to borrow is unknown, a fee this high strongly suggests supply is incredibly tight. Combine this with BIYA's small estimated float of just 2.7 million shares, and you have a recipe for highly constrained borrow availability. This level of CTB can squeeze short sellers who are bleeding money just to maintain their positions. Squeeze mechanics explained. So, what happens in a short squeeze? Show animation of short squeeze. When a stock's price starts to rise, short sellers who profit when a stock falls begin to lose money. If the price climbs significantly, especially in a stock with high borrow fees, short sellers face immense pressure. To limit their losses, or because they can no longer afford the borrowing fees, they are forced to cover their short positions. Covering means buying back the shares they borrowed, which then adds buying pressure to the stock. This buying pressure pushes the price even higher, forcing more shorts to cover, creating a cascading effect of short squeeze. For BIYA, the extremely high cost to borrow means existing short positions are feeling that pressure intensely. Dilution risk check. An important factor to consider with any potential squeeze candidate is dilution risk. Sure, no dilution risk check mark. Dilution occurs when a company issues new shares, increasing the total share count and often decreasing the value of existing shares. For a short squeeze thesis, dilution can be detrimental because new shares add to the supply, which can be borrowed by short sellers, thus negating the pressure of a shrinking float. In BIYA's case, we found no recent diluted SEC filings like S-1s, S-3s, or 424 BS in the last 90 days, which is a positive sign against immediate dilution concerns. Recent reverse split watch. Now, this is an interesting one for BIYA. The company executed a 1/4-10 reverse stock split just 8 days ago on 20/26/7/13. Highlight reverse split data. Reverse split significantly reduces the number of outstanding shares, which means fewer shares are available in the float. In BIYA's case, at 2.7 million shares are post-split. While it also resets the share price higher proportionally, many microcap stocks historically tend to see renewed volatility or even a price pop within about a month after a reverse split. It's almost like the market gives them a fresh look. It's crucial to understand this is a historical pattern observed in some microcap names, not a guarantee for BIYA, but it certainly adds another layer of intrigue to its current setup. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you be watching for with BIYA? Show what to watch graphic. Keep an eye on that cost to borrow fee. Any changes could be significant. Monitor the trading volume. A sudden surge, especially on positive price action, could signal short covering. Our internal composite squeeze score for BIYA currently sits at 51.1 out of 100, indicating a moderate but notable potential. Remember, a high cost to borrow does not guarantee a squeeze. It can also reflect strong conviction from short sellers who are willing to pay those high fees because they believe the stock will ultimately go down. However, the combination of extremely high CTB, a small float, and the recent reverse split makes BIYA a very interesting case for educational purposes. In summary, BIYA International Group Inc. BIYA presents a compelling educational example of a hard-to-borrow stock, driven by its 779.7% annualized cost-to-borrow fee, small 2.7 million share float, and recent 1/4-10 reverse stock split. While the stock has seen significant declines recently, these factors contribute to its appearance on our short squeeze screener. Always remember to do your own thorough due diligence. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth stock analysis, and let us know in the comments if you have any questions about BIYA or hard-to-borrow stocks in general. Thanks for watching.